one of the top reasons first-time teams don't work out is because the team itself doesn't work out and it falls apart. There are so many players in this market that if you come today fully new, you really have to have something very differentiated. There's no lack of funds trying to raise a growth fund, but obviously that's not easy. I don't think it's out of whack to think of a 300 million plus fund to properly do early stage hardware and climate. I'll be frank with you and say that initially I really thought, okay guys, can we stop talking about branding and get back to work?
Are LPs pulling away from climate?
I don't think so in Europe, to be honest.
Carolina, thank you so much for joining me today at The Drop. Thank you to The Drop for having me in their beautiful places in Malmö. So Carolina, today there are a few topics I'd love to talk about. I think something interesting for me and for a lot of GPs right now is what makes a VC fund interesting for an LP, right? How do you do your due diligence? What are you looking for? I think the return profiles that you're looking for VCs versus other assets, as you know, you have many assets in your portfolio. And then I think maybe talking about US versus Europe. I know you're investing on both sides, so there's also a lot there. Does that sound like a good agenda to you?
Perfect. I'm excited.
This episode is brought to you by Accelerating Impact, a non-profit that drives impact finance by running free accelerator program to support emerging impact managers. By joining them, you will get coaching, training, financial support, and access to a strong community of emerging managers. Sign up at the link in the description, and thank you to Accelerating Impact for supporting this episode. Today, I wanted to start with a bit of context. How many funds on average do you get per year? What is a funnel that you get from application and then all the way down to investment?
Maybe to start with a bit of background on Carbon Equity, we manage, as you mentioned, couple strategies. So our flagship strategy has been a fund of funds focus on VC growth and private equity funds in climate. So maybe I'll focus on that one. I think on that end, we've tracked somewhere above 600 funds that would potentially be in scope for our program over the last, let's say, 4 years.
So that's 600 climate funds.
Yeah. And that can be, that they do, let's say, majority climate between 50 and 100%. Let's say not necessarily a fully climate fund, but that we've interacted with that could be in scope for our program. And we've invested now from that strategy probably in slightly above 20 funds by now. So that gives you a sense of the funnel.
Yeah, for sure. And I think that also, maybe that's a hint for the rest of the episode, but I think if you come to an LP with just like, we will invest in climate companies at seed, right? Like that is not a compelling story, I guess, right? But maybe people enter the funnel and you'll start to look at them more specifically. And as you said, you've selected 20 out of 600. What goes into that selection?
I think many things. And you asked at the beginning sort of what is important in a VC fund. And I think that differs sort of depending on the stage and the strategy of the fund. But in general, you look at kind of many things. So you're, of course, looking at the strategy, really the thesis behind it. Like you said, there's a lot of climate tech funds that maybe from a one-pager look rather similar. So you want there to be more of a differentiated thesis or view, usually based on extensive experience in the sector. That brings me to the team, right? So I think when we look at VC teams, the perfect team doesn't exist, but investing in climate is, as you know, different than other sectors. Not that climate is a sector, but it brings with itself a bunch of risks. It's long development timelines, potentially regulatory risk or at least influence. So you want people that have experience in this sector, ideally as investors, but definitely depending again on what kind of companies you focus on, right? If it's more deep tech or not, definitely sort of technical and operational experience in the sector that you really understand why it's different and that you're not sort of fresh into it. And of course, VC teams are usually not just one person, they're many. So you can bring that complementary experience from different people. Some are former entrepreneurs, some are sort of decades-long investors, or technologists. And that mix makes it interesting. Happy to keep going on things we look at. But
Well, maybe something that you said, which is interesting for me, you said ideally you want to see some investing experience in the sector in order to invest. Sometimes I wonder, how do you get that experience in the first place? Because it's like if you're trying to raise a fund in climate and they ask you for track record, but you can't have a track record if you don't have money to invest. How do you solve for that?
if you're a fun one, you mean if you're just
Yeah.
getting started? Yeah, great question. I think sometimes something that I advise to first-time funds is to maybe start with a smaller fund or a angel track record, sort of start building that proof of concept as early as possible. And I think there's sometimes funds go out to market and they have 100 million or even larger targets, and that can be quite difficult to raise, right? So I think if you're just trying to think more from a, I don't know, operator perspective, like make it small for yourself first, maybe raise from a couple LPs or friends and family or whatever you can sort of manage, have a 10 million first fund or even a angel investment track record from your own capital. It helps a lot from an LP perspective if you're able to come and say, okay, this is sort of my first institutional fund, the first time I'm raising 100 million, but hey, look at the kinds of deals that I've done in the past. Because I think one of the biggest issues, of course, with first-time teams is that you don't really have visibility into what will they actually do with the capital. And especially nowadays where there are a lot of climate funds already that have been at least operating in the market since, I don't know, 2020, 2021. Starting today as a first-time fund is very difficult.
And when you say, when you talk about the team, I think something that's interesting for me is like, do you want to see past experience together as a team, or is it more important that every single element of the team has experience in the sector?
So we've done both. I mean, obviously, ideally, of course, they've worked together because one of the top reasons first-time teams don't work out is because the team itself doesn't work out and it falls apart. And that's really the risk you take also with first-time teams. So, of course, it really de-risks the investment if they have a working relationship together. Or even I mean, ideally, sort of the ideal version is that you've done this strategy before and, that really de-risks it for an LP. But if there's at least past working relationship or past even personal relation between them, it's something that de-risks that potential falling apart. That definitely helps.
And have you invested already in Fund One in any specific fund, or are you always coming later with carbon equity?
Good question. Yeah, we did especially in the early days of carbon equity. We started investing, I think, mid 2021. So one of the first fund investments we made was the first time fund. I think nowadays it would be very difficult for us to invest in a sort of fully first time team. We have still looked at, for example, first time strategies out of existing platforms. So a platform that is known for either a generalist strategy or I don't know, early stage strategy that is setting up a new team to tackle a different stage or sector, that we have looked at and we will continue to. But I think, like I said before, there are so many players in this market that if you come today fully new, you really have to have something very differentiated, I think, for an LP to have a look.
Interesting. And is there some sort of access required from an LP perspective? Because, when you said, like, when you started with carbon equity, you've invested in first time funds. What I wonder is it the same as in VC where eh, you need to have access to the best funds as an LP, or is it like, GPs want money from anyone, basically, right? Like, what's your sentiment on that?
Yeah, when we started Covert Equity, I think one of the sort of concerns or questions we had in our head was, will we actually get access, right? Because we were a new player and yeah, we didn't even know how much we were going to be able to raise for our fund of funds. And in the end, we didn't really find that an issue, to be frank. I think most funds, and I want to say like 99% of funds in the climate space, are not sort of oversubscribed on their first close. So they do welcome more LPs, I would say. So we haven't found that an issue for most funds. I think there are some, especially in the US, that can afford to sort of have a fundraise done in a couple months, but that's really the exception in climate.
Yeah. And I think also the fact that you're coming at it with an angle, which is like, we're going to invest in climate funds specifically, like you have also like an interesting thesis where you bring private individuals behind the fund as well. I think that makes a good mix for people to want to have you as part of the cap table of a fund. Are we calling that a cap table?
Yeah, no, I guess so, but yeah, part of your LP base.
Yeah.
Yeah, I think that's something that we've noticed when we start doing fund investments, also basically how mission aligned the VC partners are, right? I mean, they're also doing this for a reason and they resonate with our mission. So that's also a reason indeed that we get access.
For sure. Well, I guess to transition a bit to another topic, I'd love to talk about the diligence playbook that you have. You already mentioned a few elements, looking at the team, looking at the thesis, but once you get a bit later in the process and you really want to start seriously considering investing, what type of questions do you ask yourself? What do you look at in the maybe track record or whatever that is? How do you think about the size of a fund, for example, if it's well sized or not? All of these questions, I guess.
Yeah, great question. So, team and thesis we talked about. I think to your point, something else I would mention is portfolio construction and fund model. And again, obviously that changes depending on what kind of stage companies you're looking at. But in climate, in our brief 5 years of investing in this sector, we have learned that you really need a properly sized fund model, especially if you're doing hardware in climate, especially at the early stage, because of how long it takes to develop these technologies. So
What's a good size for hardware climate fund at pre-seed
at pre-seed,
or seed, like early
um,
stage?
so I think what we end up seeing with early stage climate funds is eventually they become multi-stage funds in a way, because you maybe enter at the seed stage, but you need to follow on in so many other rounds that in the end, actually your capital ends up being deployed mostly at the Series A plus, or at least equally. So I don't think it's out of whack to have to think of a 300 million plus fund to properly do early stage hardware and climate. Because I think something we've seen is that if you have a 100 to 200 million funds trying to do early stage hardware and climate, which I think actually maybe most funds are around that size, you eventually really get tapped out. Sometimes even after the Series A, because especially in 2021, 22, a lot of companies were able to raise. So you came in at the seeds and also at the A, and then the B really gets tricky, or maybe even the A gets tricky, and then you're tapped out. Rounds can get aggressive, especially these days, pay to plays, etc., warrants, and then you don't get access to that, and you maybe lose rights. You get massively diluted. So we've just seen that having those, reserves, and not just as a percentage of your fund, but really like absolute euro amount reserves, is super helpful in climate.
So are we thinking too small? Are the funds too small in Europe?
Yeah, maybe. I mean, there's, as you know, a lack of growth capital in Europe in any case. So I think even if you're an early stage VC, you have to be able to think that you will be able to meaningfully support your companies throughout that journey. Because if you can't, and then it sort of, you struggle to form a or a B round, then that can mean sometimes the end of your company, or it can mean endless bridges to nowhere. So I think perhaps we're thinking too small. And at the same time, where will that LP capital come from in Europe?
Right. And that's, I guess, a very interesting topic, because I think a lot of funds are thinking, okay, we'll raise 100 million, maybe a little more, and that way we know we're going to get there. But I've heard from a few GPs actually that told me LPs wanted to put more money, and some specifically when we think about the big institutional players, they don't want to like invest a million or 5 million in a fund. They want to invest a big tickets like 50 million plus. So maybe like what would be your reaction if someone comes tomorrow and say we want to raise a 300 million early stage deep tech climate fund in Europe?
Well, I mean, we've looked at them. I think it's needed. We don't have these really big players in Europe. I think I was speaking to somebody yesterday who said there's maybe like 500 million plus climate funds, or even not even climate funds, just funds in Europe. So I think that would be something that the ecosystem needs. And that's, again, I'm not sure if you can raise that in Europe today, but definitely a gap.
Okay, so would you think that's a gap from a financing point of view? We say like startups in Europe are struggling to raise cash. I guess if you go up the value chain, do you think we are lacking some LP money then in the ecosystem?
Yeah, or perhaps sort of a rerouting of LP money, if you can say. So I think what we've done very well in Europe in climate is to fuel the early stage ecosystem over the last 5 years with players like the EAF really kind of doubling down on the sector. And on the one hand, that's really great. It fuels our sector, but on the other hand, maybe it creates these imbalances, right? If you fuel a lot of the kind of funds around the 100 million size that do the seeds, the pre-seed seeds, maybe the Series A's, you also create this very noticeable gap now at the growth stage. So I think I don't know if we need well, obviously more LP capital is always welcome, I'm sure, in the sector, but perhaps it's more that these really large LPs in Europe think more broadly about where the gaps are in climate and to try to fill those as opposed to sort of fuel all of the above.
Yeah, but maybe that's also something to take away for GPs listening to the podcast right now. There's a clear need for growth capital in Europe, and I think a lot of LPs are wanting to invest.
And I think they see that as well. I mean, there's no lack of funds trying to raise a growth fund, but obviously that's not easy, as we've discussed, especially if it's your first fund. So it's, I think it will develop, slowly. But what we were saying before, even for the early stage funds, when they're raising next, sort of trying to think, okay, are you able to be that multi-stage fund and not just the seed check? That's important if you're doing really hardware, right? I mean, there's plenty funds that are more focused on the asset-light software funds. And then, of course, you can have a really good strategy at 50, 75, 100 million, but it's a very different playbook.
For sure. I guess something else I wanted to explore with you is so you have a bunch of different assets. You have direct deals, VCs, growth stage, PE. You were telling me before that you might also explore other avenues later. What's your expectation from a return perspective when we think about climate VCs in Europe?
Great question. So, okay, so maybe to lay what we have at Carbon Equity, we have a fund of fund that focuses on VC and private equity funds. And then we, I think, target pretty similar returns to what a VC fund would pitch you. So I think all VC funds pitch a 3x on their funds.
Is that
And
realistic?
yeah, this is, we'll see. I mean, there's nobody that I've seen has proven that in climate yet, right? So it's all sort of believe in what our sector can do. And I mean, of course, we are only focused on this because we believe there's a huge economic opportunity. But yeah, it's very much TBD, I would say. But anyways, our fund on that side would target, let's say, 2x net on let's say, to our investors. And maybe what they said, like 20% IRR, something like that, to our investors, maybe 18 to 20.
How does that compare with the rest of the asset class if we think about private equity or growth stage?
Our fund of fund sort of combines early stage VC through growth and buyout. Obviously, you have different expectations for a seed stage fund that could really outperform versus a buyout fund where we would be very happy to have a 2x on that fund, right? And then maybe more interestingly, we also have a infrastructure strategy, which then has a very different risk return profile. Yeah. So it's more of a IRR sort of game there where we target more 10 to 12% net returns, but where you also get cash yield maybe upfront through projects and the cash flow profile is just very different. So our goal at Carbon Equity is sort of to provide these different flavors of the private markets to our investors so that they can choose what their risk, let's say, tolerance and appetite is.
Okay, that's very interesting. I think it's for me, it's super insightful to be talking to an LP that also has a multi-asset strategy as well, because I think it also puts VC in perspective in terms of potential return and risk as well, right? Like I think VCs can promise high returns, but there is also a lot of risk associated to it. Another topic which I think is definitely something that a lot of people really want to talk about is we are the drop. I've talked to a lot of climate funds that are trying to maybe raise the next one or the first one, and all of them are telling me we're struggling.
Mhm.
We are not like getting the close as fast as we wanted to. Are LPs pulling away from climate?
I don't think so in Europe, to be honest. I mean, the fundraising market is definitely very tough right now, and the tides have turned for sure over the past year. But when I speak to, so basically LPs that I would compare notes with in Europe, they all seem still very committed. I think in Europe, we're very, in kind of quote unquote, lucky that we have this super strong sovereign wealth LP base that I think remains committed to climate, as well as a lot of banks, pension funds, insurance companies. So in climate, I really have not seen that because in climate, or sorry, in Europe, I mean, in Europe, I have not seen that because I think a lot of LPs in Europe have sort of maybe dedicated climate pools still, or even impact pools still that they deploy capital out of. In the US, the conversation is very different, right? So there, certainly things have changed. When I speak to LPs there, maybe there in the US, there were a lot of course, foundation, endowment, capital, and we've seen in the news that those are in a interesting position right now with the US president. So in the US, I think they're having probably or the LP sentiment has changed more than in Europe.
And does that mean that we will see a new type of branding in climate? Because I mean, a lot of people right now are talking about resilience, sovereignty. Some are talking defense. Do you think the branding of climate is just not the right one, and that's why people in the US maybe are moving a bit faster towards something else?
Yeah.
And is that going to happen also in Europe?
Yeah, I think when we kind of earlier this year, I think there was probably a wave of funds saying, I don't know, generalist funds saying climate is dead. We saw those tweets, or climate tech funds rebranding. I think throughout this year we've seen that more kind of pitch decks that were called climate funds. Now it's called resilience funds or energy funds or something else. I'll be frank with you and say that initially I really thought, okay, guys, can we stop talking about branding and get back to work? And it doesn't really matter if it's called climate or energy. Let's just invest in the technologies that we are excited about and that we need. And I think that sentiment is still true, but from a fundraising perspective, if you're talking to LPs that are not deep in the climate space, so that's everything we do at Core Equity. We don't care about what word you use because we can sort of go a level deeper and see what technologies you're investing in, and we care about that. But if you're talking to a generalist LP, especially in the US, that does not have a climate mandate, just generalist mandates, they are actually influenced by these words. So I actually do get it now why people are starting to do this.
Does that come from the fact that because you're investing directly as well into companies, you have more expertise in the technology as well?
I Yes, I think certainly the fact that we've started doing co-investments over the last 2-3 years has helped us be better fund investors, to be frank. But also because even if just from our LP hat, we only look at climate. So I think by now we have exposure to almost 250 companies. Some things have gone very right over the last 5 years, some things have not. So those sort of sector-specific learnings help. Um, and in the end, yeah, we can just sort of go company by company with a fund versus maybe stay a bit higher level.
Something that we see a lot in the US happening right now, probably not in the climate ecosystem yet, but at least in the more traditional VC space, is consolidation into very large platform
Hmm.
funds. Um, is that something that you expect in climate to happen as well? Do you think we've launched too many funds and now that they're going to consolidate into bigger platforms that have more capital to invest, maybe at growth stage as well? And, maybe that's the solution to solve the problem that we have.
I think I've heard a couple cases of that happening. Maybe more so than consolidation. I think we can expect attrition in this market. As you said, there's obviously a lot of funds in the same way that a lot of companies raised capital in 2021 and now are maybe naturally dying or not being able to continue to raise. I think that will happen to some funds as well, right? A lot of funds raised capital in 2021. Maybe it was their fund one or their fund two, where they could still raise with, not really a lot of proven returns. And now they're coming back, especially this year, a lot of funds are coming back with maybe fund twos, fund threes. And I think especially once you get to that fund three and you've gone through 2 cycles, then LPs start asking a bit more critical questions around performance. So I think it will be maybe not this year, still a bit too early, but definitely next year, over the next, let's say, 12 to 18 months, we will start seeing funds also not be able to raise. And I think perhaps that's also natural and healthy in the ecosystem.
Yeah, and I think that's also maybe a sign that the ecosystem is maturing a little bit and getting smarter. I think what you said on the branding earlier, sometimes it's, I had someone telling me this story, and I think, or this sentence, which I think is very much accurate, which is everything is climate until it's big enough and it becomes its own category. And I sometimes think about that. For example, take the energy sector. It used to be really part of climate. That was maybe the basis for first climate tech investments. And as we are getting smarter, I guess, in energy technologies, a lot of funds, a lot of companies call themselves energy companies. They're not
Mm-hmm.
referring to themselves as climate companies. So maybe that's also like another way of seeing it, as like the ecosystem is getting smarter, and as such there might be some attrition, but there might be also consolidation, and there might be also new emerging topics, I guess, and more specialist funds. Something else on that is, do you? So climate is freaking complex when it comes to the scientific aspect of the investing part, right? Like there's a technology risk that is huge usually. Uh, do you believe in generalists to be able to fulfill that criteria in terms of like understanding enough about the technology, or do you think we need a more specialist fund in climate?
The thing with climate generalists is I think we see probably like 2 types of funds. Like you have I would call the electrification fund, which is energy and then using renewable energy to decarbonize transport, buildings, etc. Right? So in the end, that, like you said, is a lot about energy and using energy to decarbonize certain sectors. And then you have more you could call it molecules or bio-based or even more food that is different. So I think people have started splitting the ecosystem in electrons and molecules. So I think as long as you have sort of expertise, what we see is that I think you can be a generalist within one of these camps, basically. So you can be really a strong electrification, early stage fund because there's so much cross pollination, sometimes, or definitely across sectors and climates. But it gets very tricky when I think one fund tries to do all of that, right? So if you're a fund that's trying to, I don't know, make electric trucks and then also make fuels or make novel foods or agricultural inputs, those types of science, unless you have the right team, can get tricky to combine. But generally, yes, I think most climate funds are generalists, but you should sort of specify what kind of what's in and what's excluded. And we see a lot of these generalist climate funds actually a lot of the time exclude agri-food because that comes with its own sort of challenges.
Look, I think something else I want to explore with you. You're quite unique in the aspect that you invest in Europe and in the US, which is not the case of lots of LPs in Europe. Uh, What's your perspective right now in terms of the investing in climate VCs in the US,
Mhm.
as we know that the narrative right now is not holding true to what it was before?
Well, to be frank, we remain pretty excited about investing in climate in the US. And yeah, I think when you talk about climate, as we talked about before, it's not one sector, right? It's sort of, I think we say, an umbrella category for so many things. And then you have to be able to invest with managers, be it in the US or Europe, that are able to navigate through this umbrella and understand what subsector technologies have tailwinds or headwinds at different points of time. So I think that's a very good way to think about what's happening in the US right now, which is clearly certain areas are super tough. I mean, we've seen the restructurings and bankruptcies of a lot of the residential solar and kind of maybe early battery companies in the US right now. But you also see this sort of wave of development and capital and government interest going towards geothermal and nuclear and critical minerals. So I think we remain, as I said, excited about the US, and you have to invest with fund managers that understand how to navigate those tailwinds. And the US still has some sort of structural advantages, especially on if you think about the capital stack to Europe. They have that growth stage more covered still. So they are able to really kind of seed and scale companies in the US, and that's still the case. So even though things have shifted, definitely we remain pretty excited about the US.
And do you think the US has less of that, I guess, green premium approach?
Yeah, I think like why the US is interesting in climate spans from kind of historical legacy of them having gone through this clean tech 1.0 boom and bust cycle, and a lot of learnings from that. And the learnings there were indeed around unit economics and essentially customers not being ready for the product yet. And then they also have more of a history, longer maybe history in deep tech investing and understanding those long cycles. So I think when the whole climate wave came, obviously there were insane valuations and a lot of things happened everywhere. But um, there are some fund managers, as you say, that kind of went through those lessons and knew that let's not get too carried away by green premiums. In the end, we've seen it before. What matters is unit economics and customers being ready to actually buy these solutions. Whereas in Europe, obviously, we come from perhaps more of a frame of thinking that regulation is there to support industry in certain cases. And we maybe tend to rely more on or think of regulation as a more stable thing than you do in the US. And therefore, being willing to sometimes invest in solutions, or at least a lot of funds definitely did, that were not there, right? From a cost parity or, of course, not cost advantage perspective. And now we see the narrative changing. And I think maybe a lot of the funds that raised first time funds in 2021 sort of now learned their lesson, essentially. And we do see the narrative sort of converging now with the US and Europe really focused on unit economics.
And is there any differences in the approach? When you look at funds in the US versus Europe, do you see different type of fund managers? Do you expect a different type of return? Is there just like a different approach in terms of the strategy, in terms of the personas running the funds? What do you identify as main differences between these two continents?
Good question. Well, in the teams, like probably more related to what I just said, there's definitely a lot of these fund managers in the US that were part of that clean tech 1.0 cycle, either as operators in the resi solar companies that came out of that time, or as investors in that time. And I think maybe that is the key differentiator versus um, the kind of stereotyping the fund managers in Europe that definitely have a lot of operational and investment experience, but perhaps not in the sector.
Interesting. I guess something else I wanted to cover on that is so you said that the US has a better capital stack. Do you see a different dynamics in terms of like fundraising for a fund? Does it go much faster in the US compared to what it is in Europe? Do they close their fund faster? Do they have more capital allocated to their fund, even at the same strategy level?
So basically, it can go faster in the US, but look, I would say most climate funds, like the bulk majority, will struggle to raise. Will at least need 1 year, maybe more, maybe two, to raise a fund. But if there's any funds that can raise in 2 months, they're in the US. And that's because there's just more of the fund force in the US in climate, and we don't have so many of those in Europe. And in the US, you have some also really large LPs, right? The pension funds, for example, in California, that if they're supportive to your funds, can write super big checks and then just makes it faster. Yeah.
For sure. Very interesting. Well, look, I do have, I guess, transition to another section of this episode, and I think it will probably be the last section. But there are a few things I wanted to cover with you. First, you're in a particular seat right now where you can see direct investments, VC investments, and as such, what would be your advice today for fund managers that are trying to raise funds, either the first fund or second fund, and struggling to do that? Is there any advice that you would give them in terms of like pitching LPs?
I think something that maybe LPs don't focus enough on is commercial performance when looking at a fund. So I think at the moment it can be hard to differentiate climate funds because indeed, if you're comparing, let's say, two funds are coming back from fund two, they both raised their fund one in 2021. 2021 was an expensive year. So maybe I don't know, they're trading around 1.0 to maybe 1.2 TVPI, something like that, you know? What does 1.1 versus 1.2 TVPI mean in year 3 or 4 of the lifetime of a fund? Probably not much, right? So if you're trying to benchmark funds only on kind of those metrics, really the high level fund performance metrics, it can be quite tough. So I think my advice in this case, probably for both the fund managers and the LPs, is to, I think really what we do is go company by company. It's harder at the early stage, but if the companies have sort of been in the portfolio for 4 or 5 years, you look at the investment memo, right? What did they say they were going to achieve in terms of technical, commercial milestones? And you look at what happened. Were they able to de-risk their technology as they had planned? Were they able to become revenue generating if they weren't before? And were they able to ramp revenues kind of year on year, right? So is there fundamental value, right, in the companies that funds have selected and invested in? That's what we try to do, kind of more benchmark funds on commercial performance, maybe also entry valuations. What are you price disciplined or not, etc.
Is that important to have a price discipline, or do you think GPs should get into exciting companies no matter the price?
Well, you can't do that for every company. Otherwise, you just have an overpriced portfolio. So I think there's like no silver bullet in this case. Overall, yes, it matters because you're building a portfolio and you can take that sort of bet on an expensive founder a couple times. But if you do that every time, then you're just going to be super overexposed, and it's going to be very difficult to get to your target returns probably. So yes, I think kind of in a 80-20 way, you should be generally very price disciplined. And in special cases where you can't manage to come together with the founder and expectations, but you're super excited, I think it's also okay to be opportunistic in certain cases. And as long as that's not your standard modus operandi.
For sure. Just to react on what you said, so the funny thing about VC is that the feedback loop is so long, because basically fund one is not going to, by the time you raise fund two, fund one doesn't have any results yet.
Yeah.
By the time you raise fund three, you start seeing some results, but not even everything. So you said as such, you actually look companies by companies.
Mm-hmm.
Do you think that's a case of most LPs? Do LPs actually look companies by companies? That surprised me.
Actually, I don't know, to be honest. My guess would be no, but that would be more a question for a GP, how much they get asked that in their DD. But I think it's very important because, like you said, if you're relying only on up rounds, maybe there's not been so many, or maybe they're actually just overpriced up rounds. So what does that tell you really? So in the end, if you go company by company, maybe not the full 30 companies in a portfolio, but the let's say top 10 in terms of at the moment where they're held in terms of market value, it tells you more about the fundamental value in a fund than maybe just looking at the up rounds.
And is there anything that you think LPs get wrong about due diligence in climate VC?
I think that would be my main point at the moment, just because it's just so hard to compare 2021 vintages on TVPI alone. So you have to try to kind of get a level deeper there.
For sure. Well, before I let you go, I have a couple of questions for you. Mandatory questions. Where can we find you online if GPs are listening to this episode and they want to talk to you?
Well, you can find Carbon Equity on carbonequity.com, and you can find me personally on LinkedIn. I think those are the main ways, and happy to chat.
Sounds good. And then the last question for today is, who's the next LP that I should have on the podcast? Is there someone that comes to mind that you admire?
Um, Yes, let me think. Um, there's many LPs I really like to compare notes with. Like Allianz would be one. I think Ferd. I think you're talking to them as well. They're really great. In the US, I love to chat with the Nature Conservancy. Um, yeah, there's several thoughtful climate LPs. I'll get back to you if I think of more.
Sounds good. But look, I think it's great to have LP conversation as well, because I think it opens up for more knowledge in the ecosystem. So thank you for doing that. And I guess listeners, if you like this episode and if you like the show, don't forget to like, comment, and subscribe if you're on YouTube, or to give us a 5-star review and a follow on Apple Podcast and Spotify. Thank you so much for today, Carolina.
Thanks, Hugo. Thanks for having me.